The next question is actually part of a group of questions, picking up really on how we deal with consolidations. So we've been given a series of information relating to questions 4, 5 and 6. And then if we just go and glance at question 4 to try and get the information out of that we need, question 4 is purely a goodwill calculation. So asking us what the goodwill will be as a non-current asset in the consolidated accounts of the ZB Group as at 31st of December 2004. So in our standard workings, goodwill is working 3, and in most cases what we're expecting is that we'll need to calculate the cost of our investment, and then assuming we haven't purchased 100% of the shares, we would need to think about our non-controlling interest, and remember that could be measured at either fair value or proportion of net assets. But once we've got those two, we would then want to go and compare them to the net assets that were actually acquired at the date of acquisition, which you may do through working 2, but in this case we'll try and put it together in one calculation, before finally thinking about any impairment that we need to account for. So if we go back to the main body of the question then, it tells us that in this case we're looking at ZB having purchased 70% of the 1 million issued $1 shares of HD, and that acquisition took place back on the 1st of January 2003. The cost of acquiring those shares then is this 3.25 million figure that we've been given here. Carries on to tell us what the retained earnings of the subsidiary company were on the date of acquisition. It then goes on to say the carrying value of the net assets of that subsidiary were considered to be the same as the fair value with the exception of one particular item, which happens to be a non-depreciable property. Book value was 1.2 million, fair value 1.6 million. So as part of our net asset working, we will have a fair value adjustment to take account of. It then says that the group policy is to measure non-controlling interest at fair value, and that at the date of acquisition, that fair value for NCI was deemed to be 1.325 million. Final paragraph is about an impairment, which says the impairment review that they've undertaken at the date that we're trying to calculate at, 31st of December 2004, suggests that goodwill has been impaired by an amount of 425,000. So if we now go and try and put all of that into our calculation, the cost of the investment then was 3.25 million. The fair value of the NCI, they told us, was 1.325 million. In terms of the net assets of the subsidiary company then, it told us that there were 1 million $1 shares in issue. So a share capital of 1 million. Retained earnings at the date of acquisition, we were told, were 1.5 million. And then that non-depreciable property, we needed to make a fair value adjustment to increase it from its book value of 1.2 million to 1.6 million, an increase of 400,000. So net assets at the date of acquisition, 2.9 million, which means that at acquisition date our goodwill would have been 1.675 million. However, that isn't quite our final answer, because they also told us that a review at 31st of December 2004 suggested that that goodwill had been impaired by 425,000. So that as a carrying amount for our consolidated SFP at this date, our goodwill should have a value of 1.25 million.